What is happening, everybody? It's Wednesday, April 20th, 2022, back with another dose of economic reality. Yes, today is 420. I hope you are enjoying your day. And if you're really enjoying 420, I hope you're not operating any heavy equipment. Let's put it like that. Now, the economy is doing great. It's doing wonderful. Unemployment is low. The unemployment rate, let's take a look at the official number. The most recent unemployment rate, 3.6%. And we are approaching the record low of 3.5% that we saw right before the health crisis in early 2020. So, yes, the economy is booming. So that must mean that Americans and consumers are doing so well that credit card debt is dropping and people are paying off debt and paying off loans and getting out of debt, right? Uh-oh. Well, let's take a look at this article right here. This article came out a few days ago, April 17th. Credit card debt spikes as inflation rises. This doesn't make any sense. How can credit card debt be rising when the unemployment rate is so low? Oh, that's right, because wages are not keeping up with inflation. And even as corporate profits soar, they're not giving raises as fast as they're getting profits. What does that mean? Well, that means the people at the top are very, very greedy, and they're only going to pay the people on the front lines, the little people, the people that actually do the work. They're only going to pay them enough just to keep them from quitting. And in many cases, not even enough, because there's a lot of people resigning and quitting to go take on better jobs. So yes, corporate profits are surging. Debt is skyrocketing. Take a look at the debt from 2021. U.S. consumer debt jumped by more than $1 trillion. That's trillion with a T in 2021. People are not watching what they spend. They're not being careful about what they spend. And why would they? Because whatever you're thinking about buying today, it might cost a lot more next week or even tomorrow with the way inflation's going. So can you blame people for just going out and spending the money as fast as possible and running up massive amounts of debt? We're living in some very strange times, folks. The times where maybe your parents or your grandparents told you to save money and put money away and save up to buy, what you want, save up to buy a home. Those days are gone. Now it's spend as much as possible now because prices are going to be higher next week. Take out the biggest loan possible because you're going to be priced out of the market if you don't get a loan now and buy that home. If you don't take that vacation now, it might cost more. You see what I'm getting at here? If you don't buy that car now, it might cost more down the road. So there's this Fomo factor happening with spending, and we see it in the credit card debt, the rising debt, wherever you look. And back to the unemployment number, we know that is a very, very flawed number, to say the least. We know the real number, the unofficial number, aka the real number, is right around 24% right now. But yes, even with a low unemployment rate, debt's still skyrocketing. People are going to buy now and ask questions later because rising costs. And this is the new world. This is the new reality. The days of saving money and saving up to make that purchase are over. Now, if there's some sort of crash, if the banks fail or QE to infinity stops, and then there's a price collapse or price correction, then the few people that have been saving cash, well, they're going to be the ones in the best position. But I think what's going to happen if and when there's ever a correction, the mega companies, the mega corporations are going to come in and buy most of the assets because Americans are not really saving money, and a lot of people are not in a good position if there ever is a good buying opportunity. So it's very strange right now what's going on. This is the economic reality that we're in right now. And going back to what I said a few minutes ago, people are not watching what they spend. As far as I can see, people still taking vacations, still lines of cars out going out of SeaWorld here in San Diego, people going to amusement parks, Starbucks, people lined up outside of Starbucks, the drive-through down the road from me here, cars lined up down the road and around the corner to get coffee. Now, coffee is a whole different beast because people are addicted to coffee. If people don't get their coffee, they start acting really weird, really jittery, really shaky. Right? So there's people that could be on the verge of bankruptcy, but they're still going to buy their coffee. Now, speaking of coffee and Starbucks, let's talk about what happened to Starbucks. Well, Starbucks decided to stop doing stock buybacks, and what the CEO said is they want to do that so they can reinvest the money into their workers and maybe give workers bigger raises. This article here from the Times: Starbucks CEO scraps stock buybacks to invest more profit into our people. On his first day back on the job, Howard Schultz made an abrupt change in policy at the company as it faces rising worker discontent. So it seems like a good thing that the CEO did there to stop the buybacks and to reinvest it into the workers, maybe give the workers some raises. Well, let's take a look at what happened. After the announcement to halt the stock buybacks, shares dropped. So investors were like, hey man, you're going to use these profits to pay the workers more? You're going to pay the people that actually do the work, the people that are standing up all day, you're going to pay them more and not use the profits to buy back shares? Well, we're going to sell our shares. Forget you. That's what the investors said because the stock took a drop after the announcement. When a company does this, the workers might be a little bit happier if they're getting some of the raises now that they normally wouldn't have gotten. But now the investors are unhappy. So you see, it's a very delicate balance. And that's one of the arguments against companies that are publicly traded. As a CEO, you are required to do what's best for your shareholders and not what's always best for your workers. And please let me know what you think about that down in comments. But that is the public company way. Shareholders come first is the way I see it. Is it a good thing what the Starbucks CEO did? Or did he stab his shareholders of his company's stock? Did he stab them in the back? Well, I think it should be workers first and not some investor that's just clicking buttons on a computer. The people that actually are doing the labor, the manual labor, I think they should become first. They should be placed first. But hey, that's just my opinion. Who am I? Speaking of investors and consumer debt, investors turn cautious on debt. Now with rising interest rates, investors are starting to become skittish, especially with these bonds based on loans from subprime borrowers. And we saw a big uptick in subprime automobile loans in the past few years. And now with car prices where they are, there's been even a bigger demand for these subprime car loans. And people taking out car loans was just really awful interest rates, 10%, 12%, and even higher for people that have really banged up credit. Combine that with these record high automobile prices, and it's a formula for disaster, and investors are actually taking notice of that. And that's going to be another force to help push bond rates even higher, especially as the Fed slows down their purchases of bonds. So to lure real investors, bond yields are going to have to rise. And when I say real investors, I'm talking about anyone but the Fed. The Fed is not a real investor. I mean, technically they are an investor, but anytime someone could just print as much money as they need, do you want to consider that a real investor? So yes, bond yields are going to have to rise to have real investors want to accept the risk of these subprime loans that are bundled into securities and bonds. But hey, who needs to work when you could just sue somebody for making you uncomfortable? Employee's unwanted birthday party nets him $450,000 after he sues his Kentucky employer. So this was somebody that said he had anxiety. He had specifically requested that there's not any sort of celebration for his birthday because he has anxiety. They didn't listen because people still threw him a little surprise party in the office. He ran out of the building with anxiety. The company fired him because of his reaction, or they punished him, and he turned around and sued the company for $450,000. So $450,000 for an unwanted birthday party. So that's a nice little payoff for only being uncomfortable. Can I say that word? That's a nice payoff for only being uncomfortable for a very short amount of time. So there's somebody that won't have to go back to work for a while. All right, folks, I'd like to hear from you down below in comments. And the days of saving money looks like they're behind us, but if there's a price correction, or if somehow the rug gets pulled out from under this system of money, people without cash savings are going to be in a real tough spot, and the mega rich are going to come in and buy up all these assets. Or prices could just keep on rising. It all depends on the money printers, folks. And that's what's happening right now. That's who runs things. That's who's in control. And the faster you realize that, the better off you'll be. Thanks, everybody, for being here. Big love. Peace. Keep stacking. Bye for now.